We'll start in just about a minute or so when we hit 11 o'clock. And meanwhile, people will be filing in. Welcome. And we'll get started in just about 1 minute. Okay, it's 11 o'clock on the nose. Let's get started. Welcome to our webinar here. It's from Investing to Income, how RIAs are using annuities in today's marketplace. I'm Kerry Pechter, the publisher of Retirement Income Journal, and my guest today is David Lau, the CEO of DPL Financial Partners. Welcome, David, and welcome everybody who's tuned in. Now, I want to just get the lay of the land a little bit. I'm not an advisor, but it's my understanding that advisors now have a lot of people coming in to their offices, and they're perfectly rational, but they're nervous, and they know that they may not exactly express it this way, but they can see that stocks are highly priced, bonds are highly priced, and they're not sure what to do with new money or with old money, or they're facing that period between just at the beginning of retirement when they have to make some changes and they're not sure how to make them, and that there are advisors who are looking for solutions for these folks, and they are turning to something that they're either familiar with or not so familiar with, but these are insurance products that offer just the kind of protections that just might exactly fit the needs and desires of these clients, and to put them in a comfort zone. So we know about annuities are not the new thing here, though that's what we're going to talk about. The new thing is the platform that David has built, which makes annuities accessible to fee-based advisors, either fee-based advisors who know something about it or did commissions, switched from commissions. But anyway, you don't have to. The platform provides just about everything that you need to access these products, and a variety of them. So there we are. We have the platform, we have the product, we have, and we're going to find out how to put them together and bring some solutions to these clients.
Yes. Yes. So it is, like you said, and thanks for having me, Kerry. It's always great to speak with you. You always have great topics and great questions, and so it's a lot of fun. And it's very topical, to talk about retirement. I mean, everybody knows the boomer statistics, so many people moving into retirement, and retirement is different today, than it was even a decade ago. And it really requires a different approach, from advisors, for a number of reasons. One, you start with the fact that, fixed income is, at all-time low yields, even a lot of forecasts, for negative real returns over the next 10 years in fixed income. And that used to be the safe retirement asset, for people who only use investment options for their clients. And at the same time, retirement is expanding, to be 30 plus years. And so how are you going to fund a safe retirement using investments only, in a 30-year horizon? And so, for many of those clients looking at that, uncertain, but increasingly getting longer expectancy of, living to 95, 100 years old, and having to self-fund that. So super challenging. And, that's, a big reason we launched the platform, DPL, Financial Partners.
Mm-hmm. Okay. Well, let's move into our first slide. Of course, I want to just react to that. A lot of some advisors will be using this for annuities for income, right? But some of them will be using them for, 3, 5, 7 years to address something that has a time limit on it.
Yes, many use them for income, and also use them for accumulation.
Right. Okay. So let's just let's get the look at the landscape and orient ourselves sort of in the market here. Who's coming to this platform? Are they? You can see by the
So,
questions there.
yeah,
Who are they?
it's primarily and almost exclusively RIAs, traditional fee only, registered investment advisors, and that's who we launched the platform for. Because as I looked at the RIA market, and you see the evolution of the advisory market in general. A few things were happening. Number one, advisors in all channels, wirehouse, broker dealer, bank channels, advisors are moving to a fee-based model. So they're managing assets on fees by and large.
Mhm.
And also there's a best interest standard now. So most advisors are managing money on fees and acting in a client's best interest. And to the typical client, that sounds very much like what an RIA is. I'm a fee only fiduciary, and many clients will tell you that best interest sounds better than fiduciary. So but the problem RIAs had is they couldn't be holistic, so they're losing their competitive differentiation because everybody's adopted their model in terms of how they get compensated, and then their differentiation is gone, and now they're faced with a negative differentiation in that they can only manage investments and not other aspects of your financial life. So I launched DPL basically to be a platform that works with the advisor now that they're providing financial planning and wealth management, so that they can have insurance products available to them in a way that matches with their business model, and that's on a commission-free, low-cost basis. So, most of the users, we have, and we've got over 1,200 RIA firms that we work with, more than 3,000, 3,500 advisors that we serve, directly, through DPL. And we also have a partnership with Black Diamond, which, we are the insurance marketplace for Black Diamond and Advent. So we support all of their, 30,000 users as well. So the answer to the question is primarily RIAs, but we also do get, broker dealer reps who are breaking away. So
Mhm.
we're an answer, often if insurance has been an important part of their, practice, that can be a barrier to going independent, that there's no insurance solution or annuity solution if you go independent that'll work with a fee only model. So, we provide a great way for those advisors to transition from, that commission-based insurance practice as they, go independent to, make that insurance practice, fee only as well. So, our consultants kind of like working with those advisors a lot because they understand annuities, they understand the benefits. RIAs have historically been, as everybody knows, anti-annuity, and my thesis, and I think it bears itself out every day as we talk to RIAs, a big reason they've been anti-annuity is they haven't been able to get paid. It's been a conflict of interest for them.
Mhm. Mhm.
So with RIAs, we provide a lot of education as to how, when, why, and for whom you use these products. So, it's been, we provide resources directly, on our website, as well as, make available consultants for, for the firms we work with.
Mhm. What would you say that most of them are the transitional type rather than the person who's never had any exposure to commissions or annuities
No,
before?
the vast majority that we work with are the traditional that have never used annuities before.
Oh, ah, and so, okay, that's really good to know. And could an hourly advisor use your platform?
Absolutely. Hourly advisors absolutely can use our platform, and we do work with many hourly advisors. Garrett Planning Network is a firm we work with. For example, very large, well known, one of the maybe the first large hourly planning firm.
Okay, all right. Well, that gives us something to go on there. Okay, and then what you offer a wide variety of products. What I mean, what would you say would be the top interest here? We know from the sales statistics overall what people are what's selling, but what are your customers buying?
So as we work with RIAs who have, historically been asset managers, I mean, you're looking to show them how an annuity works within a portfolio. And so, like right now, fixed income is so problematic. RIAs are, looking for, annuities that can be a part of the fixed income portfolio, or,
Mhm.
that can take, the place of a bond. So the popular products, that we've had have been, fixed annuities, MIGAs is, you've got first on the list here, multi-year guaranteed annuities, super simple, product. It's just got a duration and a rate, just like a CD or something like that, but with an increasingly important benefit of tax deferral, on the product. We also see variable annuities, mostly with riders on them.
Mhm.
The business started, and I had built an insurance carrier, as Jefferson National, that
Mhm.
was really focused on the investment only variable annuity, prior to founding DPL. And so a lot of the RIA market was were users just of that type of product, because pretty
Mhm.
much 5 years ago that was about all that was available,
Mhm.
to an RIA was a investment only variable annuity. So that's all they knew and all they had access to. But now that, and when we first started DPL 3 years ago, that was a very heavily used product. But as
Mhm.
more RIAs have come to understand the benefits, of the other, product types, you know, the investment only variable annuity is, maybe the fourth most popular product, on our platform rather than the first. It's now kind of a equal mix of, fixed annuities, fixed indexed annuities, and variable annuities with income riders.
Mhm. How about the RILAs? The RILAs are skyrocketing, and they've been ever since AXA Equitable introduced them in 2011. They've had steady year-over-year increases, double digits usually. What's the interest in those?
It's, I would tell you, it's not as much as it should be.
Mhm.
The RILAs are excellent products, and part of the problem that RIAs have now, as they've had investment only, portfolios for their clients, is because interest rates have gone so low and the market has been going up for basically 13 years.
Mhm.
Uh, Portfolios for even people approaching and in retirement are much more heavily weighted to equities than they've ever been in the past.
Mhm.
Today's retirement portfolio is 60/40, for a conservative retiree. That's what our firms tell us, that we work with. That would be considered a very aggressive retirement portfolio 15 years ago.
Mhm.
So the RILA, for people who don't know what it is the ability to invest in an index like an S&P 500 index and have some level of downside protection.
Mhm.
As opposed to a fixed index that gives you 100% downside protection, the RILA might give you a buffer of 10%. Sometimes they're called buffer annuities,
Mhm.
meaning in a 1-year term, you're going to get exposure to the S&P index, but you're also going to have 10% downside protection. So if that index goes down 8%, the
Mhm.
client loses nothing. So I think they're really important products because there's so much risk in today's retiree portfolios. This
Mhm.
is a way of still finding yield, or a decent return, while eliminating some of the risk and mitigating some of that risk that's in portfolios. And I think that's just tremendously important, and it's a reason RIAs are starting to use insurance in their practice, because there's got to be some risk mitigation. The
Mhm.
traditional risk mitigation investment has been to move to bonds, and
Mhm.
bonds simply can't do that any longer. They're more or less a dead asset,
Mhm.
where they're currently getting negative real returns, let alone if you're going to put it in an AUM fee on one.
Mm. Yeah, when people talk about treasuries now and scoff at their tiny return, it makes me think of the saying that was attributed to Yogi Berra, which was that nobody goes there anymore. It's too crowded. And
Yes,
be-
that's right.
So let me just point out to those who are not as familiar with, if annuities are a complete blur to you, I'm just going to point out a couple of the differences here, because they're differences in kind and not just differences in superficially. You know, your fixed and deferred and multi-year guaranteed annuity is a bond-based product. You're tapping into the returns of the general account of the insurance company, which is mostly corporate bonds. With variable annuities, your client is directly invested in the mutual funds. They're not called mutual funds in variable annuities. They're called sub accounts or insurance accounts, or because of the tax difference.
Variable insurance trust. Yep.
Yeah, and you're investing, but you're investing directly in those things. But when you get to fixed annuities and RILAs, you're now investing in options. You are not investing in the index. You can get a structured ETF where your money goes directly into the assets in the index, but with indexed in annuities, you're now, and we'll talk about, I'll have a question about this later. We don't need to go into it now, but you're talking about what are you interested in? Are you interested in the bonds with higher bonds because you get longer duration with the indexed annuity and then the multi-year guarantee rate annuity than you can get from say a CD or a money market fund, and or you're interested in getting exposure to stock, protected exposure to stocks, or are you want to get into this less familiar area of options, which we'll talk about as we go.
And that's why, you know, the fixed products have been have been popular with RIAs, because you know the yields on bonds and bond funds has been really poor. And for example, on a MYGA, multi-year guarantee annuity on our platform, you get a 4-year rate, 4-year product, with 2.75% return, tax deferred. That's a pretty attractive investment option at this point.
And these products are also, they have terms on them, so that makes them that gives them sort of a different purpose inside a portfolio, doesn't it? That you can, if you have a goal, a particular goal, say retirement or something in retirement, or you're doing some kind of bucketing, you can apply these the terms, these products by term to your bucket window, right?
Yeah, you can. So it depends on what you're using the product for. So oftentimes with a product like a MYGA, you're using that during accumulation or even in retirement. But it's for accumulation purposes. In retirement, you might withdraw. They usually have a 10% free withdrawal capability every year, so you might use it for a little income in retirement. But yeah, when you're looking at a commission-free product, and I think this is an important point to make, is a lot of advisors who will typically bring up surrender periods as a problem with the with an annuity, and the surrender is often there in commission products, at least partially, to make sure that they can recoup the commission. When you see a surrender in like variable annuities in commission-free world, don't have surrender periods. They're completely liquid products, subject to regular IRS rules, for retirement accounts. But for other products, fixed products where you see duration, it's just like an investment. A surrender or might be there because they need they're looking for the duration in order to give you better performance within the product. In other words, because you're committing to a time period, just like you would with a bond, you typically get more from a 5-year bond than you are from a 1-year bond. It's the same concept within fixed annuity products.
Yeah, the illiquidity is not there to punish you.
Correct.
It's there to invest longer.
Yes.
So let's talk about what is on your platform and how do you choose what's there. And I've got all the criteria I could think of here. What do you? Do you filter them in any way, and what are your
Of
priorities?
course. Yeah. So, I mean, we're definitely curating, the carriers and the products that we put on the platform. We're not here just to have every annuity, or, life insurance policy available. We need to believe it's, the product is the best at doing something. Right. So, we recommend products, based on analytics and data and rates, not like sales stories. So, we're very academically driven in what we do. We use technology to find best products. So when we look to bring products on or carriers on, it's got to be a very good product, because if it's not, it's never going to win. In our world, we'll never be recommending it. So there's no point in bringing it on. So we have different criteria, though. If you look at, different products, if you're looking at, a lifetime income product, you're going to want to make sure that that's with a carrier with terrific financial strength. Right. If you're looking at a MIGA, for example, that we've been talking about, that might have a 3-year, period that they're guaranteeing for, you don't necessarily need to have, an A double plus carrier for that.
Mm-hmm.
So we'll look at MIGA products, as far as the carriers go, like across the credit spectrum, just like you would if you were looking at bonds.
Mm-hmm.
Right? So you might take a lower rated carrier who might provide a better rate, within the product, because you're, taking a little, lower rating for a better rate. So we definitely look at those things, but the criteria differs product to product.
Mm-hmm. Okay. Now, how about some of the BBB carrier would probably offer better rates, right? So,
Correct.
do you have those on your platform, or are you strictly? But then I know advisors who will only buy from an A-rated company, say for a fixed indexed annuity. But there's value in the BBBs. Do you have some? Do you have
We
both?
don't currently have any Bs, but we're B double. We're looking at, right now, bringing on a carrier with a B double plus.
Mm-hmm.
But currently we're doing, all A-rated carriers, across the board, and we think that's generally the right thing to do. Particularly if you're looking at longer duration products. In shorter duration products, even in FIA, if you're only going to be using it for accumulation,
Mm-hmm.
and it's a short window, maybe a 5-year product,
Mm-hmm.
you think, that's fine to go down the credit spectrum a little bit. But if, again, you're looking at, your typical lifetime income
Mm-hmm.
type product, you probably want to stay with the A-rated carriers on, something that could be, a 30-40 year product,
Mm-hmm.
for your client.
Mm-hmm.
But it's the other thing that we look at, which is, really important, and is something we work with carriers on, and this is probably a unique requirement, is that they have to support the RIA community.
Mm-hmm.
So, if you think about, as we got into business, 3 years ago, carriers' systems are built to pay commissions, not allow fee withdrawals, right? So that's a
Mm-hmm.
different model. Often RIAs are not insurance licensed. We provide that licensing, so we make it all turnkey. We're the agent of record. The RIA doesn't need to be licensed. They
Mm-hmm.
use us to make the recommendation and issue the policy. But we want them to be able to manage the account. So from the carrier point of view, they have to support attaching the RIA to the policy to have oversight over
Mm-hmm.
the policy, so they can report on it, they can manage the assets, make the investment choices, etc. So when we're looking at carriers, we want them to be dedicated to the RIA space. We want to make sure that they're supporting in all aspects, not
Mm-hmm.
just the product design, in all aspects of the business, they're supporting the RIA channel.
Mm-hmm. Well, service clearly becomes, I mean, after the sale, service becomes incredibly important.
Yes.
You can make a little bit more on yield, but if you're giving up prompt service, their companies have glitches, and sometimes they are slow. Some of them are slower to respond to the needs of the policyholders and their advisors than others. We don't need to just speculate on that, but it makes a difference. And I think it might be if an advisor is looking mainly at the crediting rate uh,
Yeah,
that they
there,
should take service into account.
absolutely. And that's part of the value of the platform that we bring, right? We've got 20 different carriers. We not only know about the products, we know about the service, we know
Mhm.
about the technology that they can support. So, it's, we provide that, great consolidated, one-stop shop,
Mhm.
for an RIA. Not
Mhm.
only we have the, the whole turnkey process between the technology, the products, the licensing, to allow them to use the products. We've also got the expertise and the insight, relative carrier to carrier, who does this well, who does that well, who really supports, fee billing in a robust way, those
Mhm.
kind of, intangibles, as well.
Mhm. So let's say that I'm an advisor and my client's contract has come to the end of a term and I want to switch indexes. If I'm the RIA, am I going to deal with the insurance company or am I going to deal with you to make that change?
You can do it either way. So that's part of, the model, right? So we're
Mhm.
the advisor, or we're the agent of record
Agent
on the
of record.
policy. So
Yeah.
we also, can make those changes on behalf of the client, through the advisor, or
Mhm.
because we work with the carriers to make sure they support the advisor being on the record,
Mhm.
on record for the policy. They can
Mhm.
also go direct to the carrier if they choose to make any changes like that.
Mhm. Okay. Very interesting. Okay, let's move on to our next slide. Now, a question that's always on my mind is: are people using this as especially the index products, uh, as the options-based products? Are they using them as an alternative for bonds, or are they using them as a alternative for equities, or they mainly go by tax deferral? I think many people. I'm not sure how many people realize, probably high net worth people realize that a variable annuity, a deferred variable annuity is really the only uh, product that allows you to tuck away an almost unlimited amount of after-tax money for future tax deferral. And
Yes.
that's how we mainly sold them when I was at Vanguard a few years ago. But the more important thing is, what are they using them for?
Yeah, I think, all of those things. So, definitely, again, bonds have been problematic, fixed income's problematic within the investment portfolio. So having safe options that are, also non-correlated to the market, by the way, right? Buying a MIGA or a fixed index annuity is not correlated to the market on the downside.
Mhm.
Maybe on the upside, in an FIA if you're invested in an index, but you can often get, better returns than they're getting on bonds, with, probably even better safety. So,
Mhm.
we've seen those products being, really popular, and also as, equity replacements. And I'll caveat it this way, because I mean, the way we're guiding the advisors we work with is, one, you can use the, the RILA, the buffer annuity, as we talked about earlier,
Mhm.
to be a component of the equity portfolio,
Mhm.
and to, mitigate some of the risk. Or, because, a lot of advisors have said they haven't been able to, follow that traditional investment glide path of
Mhm.
moving from equities to bonds as the client approaches retirement. You
Mhm.
start taking some, maybe, of the assets from the client that may have been sitting in equities and moving it into, an annuity product, as the client gets to retirement, because bonds, simply can't provide any yield today.
Mhm. Mhm. Yeah, I wonder, since I don't have direct client experiences, I wonder about the some of the conversations that go on. Like I wonder, would imagine it would be very hard to get people to sell their Apple stock to buy an annuity. It
Cor-
would, and it might be a very smart move.
That's right. Take your gains now, right? Before before the capital gains rates, go through the roof.
But I know from talking
But
to people that my gosh, I mean the Apple stock is a point, or Netflix or whatever it is a point of pride.
That's
You know,
right. Well, and I mean, and you totally appreciate that. You know, we
sure,
talk to,
sure.
you know, we talk to advisors all the time, and that is, I mean, like I've been saying, they've have client portfolios more heavily invested in equities than ever
Mhm,
before as they approach retirement. That's not all their choice, right? So, you know,
mhm,
the clients have been enjoying, you know, this great ride up that we've been
mhm,
having. And frankly, last year almost emboldens people and younger advisors even. You know, we
mhm,
had, you know, that huge market, you know, drop, you know, right when COVID hit and the market goes down 30% and it rebounded pretty quickly, right?
mhm,
Probably historically quickly. And so people, you know, become numb to the risks of the market. Like, oh, the market just goes up. When it went down, it was no big deal. It was back in no time. You know,
mhm,
so you become numb to the risks of the market. And at the same time, the alternatives within the investment world, you know, that being bonds, are yielding almost nothing. So, you know, it makes it even more problematic. So that's
mhm,
where the, you know, again, we're finding the annuities to be a great new tool, you know, for RIAs, you know, particularly as those clients get near retirement and they're
mhm,
looking to, you know, to fund income.
mhm. Okay. Now, this is my favorite part of it. And let's talk about the indexes. You and I have talked in the past a little bit about there are now there must be hundreds or even thousands of indexes now, and the big investment banks put them out, and they're becoming more exotic hybrid indexes. They're uh, volatility controlled indexes. What's your feeling on? We touched a minute ago on your filtering
Yes.
techniques. So what is your feeling about the indexes and and how people should use them?
That's a great question. So I think I've got a pretty blunt, you know, point of view on, you know, a lot of the custom indices that are, you know, that are in the market. I know a little bit too much about how the sausage is made, you know, so to
Mhm,
speak, in this. And so I generally do not like, you know, custom indices, because I think there's a lot of hocus pocus going on there. You know, they're built to illustrate well and to show well as you're presenting to a client. Because again, let's face it, these products, for the most part, have always been built to be sold, right? Not built to be used. And that's something we try to do at DPL. We try to bring products to market and create products that are built to be used by an advisor for a portfolio, not being built to be sold by a salesman. So I
mhm,
think a lot of the, you know, custom indices you see are built to illustrate really well,
mhm,
rather than necessarily perform really well. So we try to take the approach that we're going with basic, you know, fundamental indices like S&P 500
mhm,
or, you know, Russell 2000 indices. You know, we will be introducing, you know, our an index that, you know, we've helped put together with a, you know, very prominent, you know, asset manager, you know, later this year, which is going to be and actually a good custom index. Because
mhm,
one of the, you know, one of the things you see in indices, and smart advisors get it, and other advisors, you know, just hadn't thought of it, but when you look at an S&P index, a lot of these are, you know, price return indices, not total return. So
mhm,
dividends aren't included. So when you
mhm,
start looking at what potential performances are, you know, within these indices, and you're not including dividends, and you're trying to say, you know, in a fixed index annuity, you might get 10% return, and you know, in a custom index, it's just not going to happen.
mhm,
So, you know, so we're building an index that is a full total return index that's going to include dividends, that is, you know, going to be built to, you know, provide consistent performance and
mhm.
real performance, not just illustrate well.
Mhm. But now, even if an advisor is using basic the most common indexes I've seen are the S&P 500, the maybe the Nasdaq or Nasdaq 100, the Russell 2000, MSCI
Yep.
for developed country exposure, I think it is. So, but even then, they're probably going to look at, well, how do I allocate among
Yes.
those and when do I switch if one went up, or and how is this a set it and forget it product, or am I supposed to be watching, and then I'm frustrated because I can't do anything until the contract year ends. So those are questions that I would have if I was an advisor.
Yeah. So, I mean, again, you're going to look at that. You're going to look at what is the purpose, for which I'm using the product. Number one.
Mm-hmm.
So, and usually we're positioning as this is a fixed income replacement, a bond alternative. And so to me, and most of the, advisors that, we work with, you're looking for predictable return in a product like that, because that's what it's replacing within the portfolio, something that gave a very predictable return. So predictable returns generally, you look at, with the advisors we work with, allocating to the fixed account, within a fixed index annuity, and then maybe a 50-50 allocation between the fixed account and like an S&P index. So they're saying, I'm going to get at least a strong return from the fixed account. And the fixed accounts in our products today, pay, 2.5 to 3.1%. So they're very nice returns, for a fixed, investment. And then you say, for the other 50% of my clients' assets, I'm going to look for a little upside. And maybe you're going to get a little upside over that fixed account with the with an index. So, but I mean, it depends. So if you're looking for more upside, maybe you go into a international index, or a Russell 2000, or something like that. If you want a little more conservative, maybe the S&P 500.
Mm-hmm. But there's only so much money in the risk budget for any of these. They all have the same risk, but they all have the same budget. And so what you get by going up into a riskier index, I would think that the options would be more expensive and you'd get a different crediting rate. So there's no free lunch here if you're taking risk off, right?
Correct. Yes. And that goes to, some of the previous conversation we've had, right? So if you're looking at these products and you're evaluating custom indices that may be illustrating very, high return rates, I'm very skeptical of that, because, for the very reason you're talking about. You've got to, the carrier has an options budget, and what that options budget is the spread. And that spread is what they're paying in the fixed account. Right. So if they're paying 3% in the fixed account, that means they've got 3% to put to the index. And then, so, if you think that you can take 3%, 3%, however much money that is, and generate, in a fixed index in options, multiples of that, potential return that you would have gotten from, fixed income. I mean, I just don't think that's going to happen consistently. So, because there's other expenses also built in. I think you've got some questions on that, relative to the index. I mean, you've got to pay, the asset manager. You've got to pay the hedging company. The investment bank, who's doing the hedging. The insurance carrier's got to get paid for, executing the option strategy. So there's a lot more expenses in there, even relative to the fixed account. So it's a tough story to think you're going to get more. Roger Ibbotson, I think the best work on what to expect from indices was probably done by Roger Ibbotson 3 years ago, where he looked at 90 years of history and projected basically indices should perform about 10% higher than bonds or the fixed account, within a product. So over time, you'll probably get a little more return in an index than you would the fixed account, but not wildly higher returns.
Do you ever get any questions about the RILAs and the downside buffers as opposed to downside floors? That's a possibility for confusion, I think.
That's a great question, because, and I've spoken about this before, where RILAs are really, a little antithetical to traditional insurance. Traditional insurance is insuring against the catastrophic, right? In a typical buffer, you're insuring against the most likely losses, not the worst losses, right? Because if the insurance carrier is absorbing, in the example I gave earlier, 10% downside on, an S&P 500 index, most of the time, if the market's down, it's within that range. But if the market's down 30%, your client's still going to lose 20, right? If that index is down down 30%. Nice to absorb some of that loss, but because of the buffer rather than floor nature of it, you're not taking that tail risk away from the client. When you have the floor, which is sometimes available within those RILA products, but definitely the way a fixed index annuity is structured, you're creating that floor. The client will lose no more than this. And in a fixed index annuity, it's zero. Your client cannot lose money based on the performance of the index. In a RILA product, it might be 5%, might be 2.5%. You can set the floor. I'm willing to have my clients willing to lose 2.5%, but not more than that. So you can set those kind of floors as well. So the product, many of the products can work in either direction.
And of course, the reason for selling part of your downside protection is to augment your budget for buying upside potential, right? That's the whole idea.
Correct. So when you're looking at a at a RILA product and you're looking at an S&P index, just to keep it consistent, within a RILA product today with a 10% downside buffer, you can probably get in our products a cap rate on an S&P of about 15%. Within an fixed index where you have that zero floor, you're probably going to get 6%. So you do get a considerable amount more upside, potential for being able to take some of that downside risk, which is why I think, RILA products are so popular today, and we, try to tell advisors all the time as we're, trying to get them used to the products. It's like, present it to your client and see if it's attractive to them. It's a very pragmatic risk mitigator from your point of view, Mr. Advisor or Miss Advisor, to mitigate some of the risk within the portfolio. But clients love them. That's why they're so popular today, since they've been introduced. Because who doesn't like the notion of, in a 1-year period, you can invest in the S&P, you can get up as much as 15%. Nobody's complaining about getting a 15% return. And you're also going to have up to 10% protected on the downside. Clients love that proposition, right? And from an advisor's point of view, you shouldn't have any problem with that. That's excellent risk mitigation, and it's still very, very strong return. So, to me, like I said earlier, when we were talking about the products, in the RIA world right now, I think they're massively underused. RIAs, think that they're mitigating risk simply through diversification of their investments, and that's not enough. I mean, we've seen a lot more correlation between asset types and asset classes since 2007 and 8 than we ever have before. So you need to find ways of providing real risk mitigation, and diversification is not enough, particularly when you're using bonds less than you ever have.
You mentioned hocus pocus. Tell us a little bit about some of the hocuses and on the other hand, the pocuses.
I never split the term before, so I'm not sure which is the hocus and which is the pocus.
But we like to take deep dives into things here.
Yeah. So part of what I'll say is the hocus pocus is when building an index, volatility control. And I mean, a lot of advisors are familiar with volatility control, even in mutual funds, right? That can provide volatility control. When you have volatility controls within an index, what that is, in low volatility controls, the most popular is like 5%. Sometimes you even see them down at 3%. What that means is that if you have even a little bit of volatility in the market, they're going to be moving your assets from the investment strategy into cash. So when you have low volatility, but what it does for the for the index, it allows a pretty big options budget. So you can buy a really high cap, right? So the potential for return is high, because the cap might be, if you didn't put the volatility control on it, maybe you'd have a 4% cap. You put a 5% vol control on it, all of a sudden you can have a 10% cap. the
Mm.
chances of you hitting that 10% cap, because you're going to be in cash quite often, is, almost none. Right. But it illustrates really well, for the client, because you can have, up to a 10% return in this, year after year. And to me, that's, kind of the hocus pocus, right? You're putting together something that is going to, theoretically present well and look good, but
Mhm.
has very little chance of actually performing in that way, because of, the criteria in terms of the vol control you're putting in it.
Mhm.
So higher, I don't have a problem with higher vol control. I mean,
Mhm.
because that's, part of, again, risk mitigation. Um,
Mhm.
and so if you've got a higher vol control, which is going to, allow your client's assets to be invested in the strategy more,
Mhm.
because you're not so quickly going to be moving to cash,
Mhm.
that's a little better. But when you see all these, very popular indices with these really low vol controls, that's simply because they're using, they're getting more for their money on the option side, to have higher rates.
Mhm. Okay. All part of the under the no free lunch
Yes,
banner.
absolutely. And or no free lunch, or if it sounds too good to be true, it probably is.
Right.
Yeah.
Now, let's get a little bit close to the cut to the sort of the chase here. There's a lot of people who have to get paid, as you mentioned.
Yep.
And so what are, without getting too complicated, what are the benefits to the advisor and the client from going fee-based? Because I had an hourly, and I even had an hourly advisor ask me, could I go on there, get the the product for my client and not charge my client anything but an hourly fee, and my client picks up all the upside. Well, what is all that upside? And then the other question is whether the commission people are always asking, well, really a commission is no more expensive than a long-term but so where do the pennies land in whose pocket, and what who can expect to get what, and we can
Yeah.
focus on the
So
people that you're familiar with.
yeah, so I think, I mean, if you think about it, I mean, the simplest way to think about it is a load mutual fund versus no load, right? The product is always better. So when you're taking the commission out of the product, you're making a
Mhm.
far better product. And, commissions in annuities are far higher than loads or 12B1 fees in mutual funds, right?
Mhm.
So when you take the commission out of variable annuity, for example, you're taking the price down by 85%. You're taking it from an average of 140 basis points M&E for the product
Mhm.
down to 20 basis points. So
Mhm.
I mean, you're having a massive price savings, by removing the commission.
Mhm.
After that, a lot of like you're saying, a lot of commission people like to say, well, the client's still paying the same. But
Mhm.
I mean, that's apples and oranges. That's an argument that, literally drives me nuts, because they're completely different things. They're similar in that they're different ways that advisors get compensated. The
Mhm.
commission is a payment from a product company to a salesman for the sale of a product. A fee is a payment from a client, not a product company, from a client to an advisor for
Mhm.
financial advice.
Mhm.
The cost of the commission is built into the product and will never go away.
Mhm.
After the surrender period, the cost of the product doesn't go down. After the carriers recoup the commission, cost of the product doesn't go down, stays the same. In
Mhm.
the advisory world, the client can stop paying the advisory fee at any time they choose, right? So, day two, they can not have their financial advisor anymore. So that argument, and I hear it a lot from commission people, it just doesn't hold water. And so, but to get to the question of where all the who's getting paid. I mean, it's in any insurance contract, you've got the carrier. Whether you've got a variable product, you've got the costs of the funds that are in there that the fund company is getting paid. if you're looking at the, an index, which is, I think a lot of the point of the question here, you've got, the insurance carriers getting paid for the product. You've got the options writer, usually the investment bank, who's getting paid to manage the options. Then you've got the index provider, who's usually an asset manager, who's getting, an asset management fee, or technically a licensing fee for licensing, their index in the product. So those are kind of the components. And then as far as, advisors go, it's the same as any other asset that they're managing. For a AUM advisor, they would include it in their AUM. For like your friend you referred to, who's an hourly planner, it's just another thing that you might choose to have your client invested in within their financial plan, and you still just charge your hourly rate. So it becomes a discussion of compensation strategies rather than product. The product is what it is. It costs what it costs. It is what it is. And in a commission-free form, annuities are far cheaper, than in any other form. And then it depends on, what kind of advisor you have, whether you've got the hourly planner or you've got an AUM-based advisor. That changes what the customer, might pay for that financial advice, but the product's still the same.
Yeah, well, that's a very different discussion we would have about, the value of continuous advice versus hourly. So that's a different subject for another day.
Yes.
The options writer, I imagine that they do very well. The folks on Wall Street generally are not,
Yeah, they're pretty sharp.
Yeah.
So they know how to make money.
I've heard that the only way you're gonna make a killing on a index product is if something happens in the market that just throws the options writer through them way off, and
Right.
and so that's not that's
Yeah.
getting lucky.
Right. And again, the way we're thinking about it is you're not looking to make a killing on these products. And that's part of the knock, right? That a lot of commission salespeople are trying to position a fixed indexed annuity as, really, you could potentially get, really high returns with no downside, et cetera. And that's like, as I was saying earlier, that's fantasy. That's not going to happen. This is a fixed income replacement. You should think of fixed income like returns in this marketplace a little better than you're going to get, in your traditional fixed income. But you're not going to go into a really conservative product like an FIA and expect equity like returns. And if someone's positioning it that way, then they're being disingenuous. A RILA, yes, I can, the buffer type annuity, a little bit more equity like return, because you do have those higher caps and higher upsides. But in an FIA, you're going to get 3 to 5%. I mean, that's what you should be thinking about.
And then how do you get paid, and what kind of a margin what does that add to the situation? And then what do people get in return for working through your, what kind of resources do you offer? I know you mentioned, I want you to get in there. You had some comparison tools that sounded very good.
Yeah. So there's a lot of stuff there. So quickly on how we get paid. So when an insurance carrier is pricing an annuity product, just like anyone else, right, in financial services, whether it's a mutual fund company or whomever, you build in the cost of distribution into the product. So whether you've got to pay a platform or a wholesaler or whomever. So in an annuity world, in the commission world, you've got a big commission, maybe 8%. And then you've got their internal distribution expenses, which is paying their wholesalers and, kind of famously paying for sales, contests and steak dinners and marketing and advertising, all of that baked into the cost of the product. In our world, we eliminate the commission, so you're immediately taking a big expense out of the product. And then, we have what we call an administrative fee, because we're providing a platform to issue these policies for unlicensed, typically advisors, in the RIA channel. So for that service, we charge the carrier, and they replace their internal distribution fee with our administrative fee. they're typically, at maybe 2%, for their typical internal, distribution expense. We are typically 100 to 125 basis points that gets amortized across the expected life of the product and built into the product pricing. So when I say, a variable annuity on our platform costs 20 basis points or maybe 30 basis points, our fee is built into that cost. So you're not getting, the client's not getting an extra fee for that. That's part of the base, our fee is part of those basis points. Just like the other, other in commission products, 140 basis points also comprises some of those distribution expenses. So for the advisor, this is kind of business 101, for the RIA. Is I'm adding a whole nother, share of wallet, from existing clients. So it's kind of business 101. I should be adding insurance to my practice because I'm getting a greater share of my client's wallet, number one. Number two, I'm holistically serving them. They don't need to go to to an insurance provider, an insurance agent who's increasingly competitive with you, by the way, as an asset manager, to go get their insurance fulfilled. So, for the advisor, it makes, complete business sense. And what we do to support them is we have, a team of, 40 licensed consultants, who can work with them to help find best products. As you're mentioning, we use technology to find best products. We've got, completely unique proprietary, technology that can do product comparisons across all product types. If your clients own existing, commissioned annuities, we've got a tool that'll, enable you or one of our consultants to, compare them and, in about 10 seconds to find out whether we've got a better product or what their product might perform like. So we provide them, the advisor, all of the support that that they need to provide insurance to their clients, completely turnkey. They can have no insurance capability or licensing today. They sign up with DPL and tomorrow they're fully capable of serving their clients.
Sounds good. Well, I think we're going to have some questions, and we always do. And let me just see if I can get them up on the screen. First question was, how does the platform differ from incomesolutions.com, Kelly Hewler's platform that started out as a rollover income solution for Vanguard participants, and now is open to advisors and individuals. So I think that's a short answer. If you want to, do you want to take it?
Yeah. So we're providing, nothing but commission-free products, and we're actually executing, the products and, serving as agent of record, for the advisor. So we're going to utilize our technology based on client specifics to find the best products for the client, and then we're going to actually execute, for the advisor. So we serve as agent of record. We implement the the product on behalf of the advisor for the client. I'm not fully familiar with the capabilities of the Income Solutions platform, but I think what I just described is probably a pretty big differentiation.
I don't think that's necessarily a fee-based platform.
Correct.
I'm not 100% sure, but they have a different approach. They have a bidding system. You submit what you want. An individual without an advisor can submit say what they're looking for. Say an immediate. Usually, it's an immediate annuity in her case, and so they get bids. You don't have a bidding system where an advisor says, my client wants to buy this and we're going to have 20 insurance companies bidding on it. That's what she does.
Bro, got it.
Let's move along. The question number 2, our industry continues to overlook the impact of the shift from an after-tax to a tax-deferred asset with the acquisition of a non-qualified annuity contract. Please discuss and include the impact on the estate plan.
Okay. I didn't completely follow the question. I mean, is it, asking about non-qualified stretch?
I think he's just wondering, why am I how is this going to affect it? What are the tax implications of going into
Yeah.
an
So,
annuity?
yeah. So you should be, aware of, the tax implications of anything you invest in. And so with the annuity, and so the way, again, we're talking about using them is for, tax deferred accumulation. One of the, things advisors bring up often is that, gains come out, being taxed at ordinary income rates. So, that's, as opposed to, getting, capital gains treatment, for one.
Mhm,
That's a fact of all retirement products. Number
mhm,
one. Number two, so we, are typically looking at people using, as I was describing earlier, a lot of fixed income replacements. And so
mhm,
fixed income is already taxed at ordinary income rates. So tax deferring fixed income is just an additional reason, for
mhm,
using an annuity, because you're not only going to get, oftentimes a better return, and a really strong interest rate, you're going to get the benefit also of tax deferring those gains, or I'm sorry, the interest, tax deferring the income from the interest off those products. But you should be aware of it, right? So if you're using a variable annuity,
mhm,
where you're going to, where you are trading off, capital gains for ordinary income. I wrote a, white paper on this, some years ago, and David Blanchett and Michael Finke actually just, wrote a very similar one, talking about what asset classes make the most sense to use within within a variable annuity, or a tax deferred structure. So, for example, large cap funds are generally pretty tax efficient. The break even point for that tax arbitrage on a fund like that is 20 plus years. So that's probably not something that you're going to get a lot of tax benefit from. However, like small cap funds that generally have a lot of turnover,
mhm,
within them, that are generating a lot of short term capital gains,
mhm.
a break even period for that might be a 5-year hold. I'll have to refamiliarize myself with some with some of the rules of thumb
Sure.
we came out in the white paper. But the bottom line is, be cognizant of what the tax implications are. Invest prudently, within the different product types, and you can still, use a variable annuity, very wisely for high income earners to help defer taxes.
Yeah. Well, I've always felt that if taxes are your biggest problem, then you're rich. So,
That's right.
but that's all relative. Also in retirement, taxes are probably your biggest expense, and
Yep.
suddenly you retire and they loom suddenly, immense. Okay.
Yep.
How about inflation linked annuities?
Yep.
Where inflation is now, the topic du
Yes.
jour. We must have a lull in things to worry about because now we're
Right.
talking
So
constantly about hyperinflation. Inflation linked annuities, are they on the site?
So you almost cannot find an inflation linked annuity. You may not be able to even find one. The problem with inflation linked annuities is the cost of providing that, because the carrier's got to, if you're truly linking to inflation, the carrier's got to price in potential hyperinflation, right? So you wind up with a very expensive product for that benefit.
Mhm,
So what we do have are different products that have rising income features, which aren't technically tied to inflation, but one that we have, for example, has a 2% annual COLA.
mhm,
So the income rises 2% year after year after year. May not be a perfect inflation hedge, but you're getting the benefits of increasing purchasing power, or purchasing power that is trying to keep up with inflation. Over the course of time, other products we have that, depending on the performance of the product, the payouts rise every year. So you definitely have those kinds of options, but not true inflation linked.
mhm,
Um, so for that reason, many academics will tell you, utilize, because you're going to utilize the annuity for very efficient income. Meaning in today's world, Wade Fowler's got the statistic that an annuity is going to fund income more than 40% more efficiently than fixed income in a low interest rate environment, like today's environment. He said he's actually got to go further out than that at this point because interest rates, real returns have gotten so low. So meaning for the same amount of income that $1 million would fund in fixed income, it would take $600,000 in an annuity to do it, which leaves more money to be invested in the equity and legacy portion of the portfolio. And most academics say that's the way you should look at it as an advisor. Use that portion of the portfolio for the inflation protection. Use the annuity for the income.
Now, here's a timely question. What will happen to annuity tax deferral if capital gains rates go up to ordinary income rate? I guess the question, I mean, no one knows, right? But I think the question is how would that change the appeal of various products?
You would think it would make it takes away that arbitrage that we talked about earlier, right? I mean, so you would say absolutely use an annuity to tax defer because there's no, equity investments because you don't have any difference between capital gains and ordinary income rates. So go ahead and absolutely use them. The caveat I always make, when people, because you said earlier, Kerry, very perceptively that many people don't think about a variable annuity for tax deferral or tax deferred growth, and they should, but the caveat is it's got to be a low cost one, right? Because the value of tax deferral isn't infinite. It's finite, and depending on the tax rates, and what's going on, it's roughly 200 basis points is what a lot of academic study will come down to. It's worth about 200 basis points to the performance of a portfolio. So the cost of the product in order to get that tax deferral, the lower the better, right? So if you can get a variable annuity with good investment options for 20 basis points, your client is going to be very well served by using it for tax deferral because you're going to get the benefit. If the product, like a traditional commissioned variable annuity, costs 140 basis points, and then you might have expensive mutual funds, you've completely eviscerated the value of the tax deferral. So you would never think of using a traditional commissioned, variable annuity. You'd only use, ones like, from Vanguard or, or others, like we have on the platform that are, really inexpensive.
Okay, we only have time for a quick last question. How can we access your white paper, the one that you referred to, or you referred to a couple of them, I think?
Yeah.
Are they on the website?
I would be disappointed if my white paper was not on our website. Yeah. So I'm almost 100% sure that it is. If not, if you can, get your contact info to Kerry, and we'll make sure to get the white paper to you. It's a little bit dated, but conceptually, very strong in terms of the way you're going to want to look at, different asset classes and the break-even points for tax deferral. It's a pretty good paper, and I felt very validated when Michael Finca and David Blanchett told me that they came out with basically the same results that I had. So,
what is imitation is the highest form of flattery?
Well,
okay.
Yeah.
Well, I'll just end with a thank you and a short plug for my publication, Retirement Income Journal, is published weekly. It's a subscription-based publication and goes out to about 7,500 people every week all around the world. And most of the major annuity issuers have corporate site licenses to it. And if you're interested in subscribing, you can just go to my website. And if you want to get a taste of it, you can get the first 6 issues free by subscribing to the newsletter, which is available, which will be available there in an irritating pop-up when you go to the homepage. Okay, thanks everyone very much for attending, and I hope we see you at our next webinar. Thank you, David.
Thanks, Kerry. Enjoyed it.
Bye.